Welcome to Retire with Purpose, a show specifically designed to help you maximize your financial confidence in retirement. Casey Weade is the CEO and Chief Visionary of Howard Bailey Financial, a certified financial planner and Wall Street Journal best-selling author. He's your host on Retire with Purpose.
Hey, I'm Casey Weade, and we believe in retirement strategies that are driven by meaning and purpose. Join us this week and every week as we discuss planning for your best retirement, pinpointing your purpose, building a rock-solid financial plan, and unpacking trending topics that could impact your financial future. Welcome to the show. Welcome to Retire with Purpose, the science of retiring with confidence, the art of living with purpose. This is your host, Casey Weade. Joining me, my good friend and co-host, Marshall Johnson, here with me.
Hey.
And we are here to discuss retirement with you, whether you're at retirement, in retirement, near retirement, or you're just seeking that coveted job optional status. You have found yourself a home. We're going to have a wide-ranging discussion today, talking about everything from paying off your mortgage in retirement. Should you do it? Should you not? What are the tax consequences of taking a large distribution from an IRA to pay off that mortgage? Pros and cons. We're also going to discuss carrying life insurance in retirement. Should you stop paying those premiums? What are the uses of carrying that life insurance into retirement? We're also going to talk about retirement rules of thumb. We're going to take a second look at some of those rules of thumb. Did someone tell you you should use the rule of 100 when it comes to how much risk you should be taking with your retirement? Well, we might just debunk that here in just a moment. But off the top, we're going to be discussing an article from our Weekend Reading for Retirees email series. That's one email that goes out every single Friday, hits your inbox, and that comes directly from myself. Marshall and I, we do a lot of research throughout the week. We read a lot of articles, and we said, hey, instead of just talking about these articles between the two of us, why don't we share these trending topics with you to help you make better decisions in retirement? You can sign up to receive that article and our summary and takeaways every Friday over at retirewithpurpose.com, where you can also check out the podcast, where we have a full-length discussion on the article we're going to cover with you here today. And that article comes to us from Forbes. It is titled, What is Secure Act 2.0 and How Would It Change Retirement? Again, go to retirewithpurpose.com, listen to the podcast, and get a link to this very important and timely article.
Absolutely. So if you hadn't noticed, there's a new bill that's winding its way through Congress. And this is what I love about our show, Casey, is the ability to talk about news kind of as it's breaking and how it impacts retirees and savers, because this is a big deal and it's going to wind its way into most people's lives and how they save for retirement.
Yeah, the Secure Act 2.0, as it's being dubbed, is actually known as
informally, right?
It's actually known as H.R. 2954, the Securing a Strong Retirement Act of 2021. Ooh. It passed the House Ways and Means Committee on May 5th. It's headed to the full House with strong bipartisan support. Mm-hmm. And be prepared to be a little bit overwhelmed and not really know who you should believe on this one. It's 146 pages. The package is 146 pages and carries with it numerous different provisions that will have an impact on your future retirement decisions. Those of you that are still in retirement, it may impact you as well. There are some major changes here. The Secure Act was originally passed by Congress in 2019. And that was an overwhelming and sweeping piece of retirement legislation, the largest that we had seen in many decades. And just as you look at that old Secure Act, the one that was passed not that long ago, you may find that some of those were pleasing provisions, some were frustrating provisions. I think you're going to see the same thing here with Secure Act 2.0. There's going to be some things in there we go, hey, that's a good deal. There's going to be other ones that frustrate you, make you red in the face, and want you to pound your fist and pick up your local congressman.
Yeah, that's the key takeaway. Not the congressman part, but it's going to frustrate some and please others. You know, we reviewed 5 articles on this very topic, and it was hard to choose which one we eventually were going to send out to our clients. But you're absolutely right. You know, anytime there's sweeping legislative changes, why on earth are tax laws going to change? We've been talking about this for years. We feel that taxes are going to go up. How do legislators raise taxes? Well, they put it in bills, and there's a lot of stuff in there, and some of it gets buried in the headlines, kind of like the stretch IRAs were in the original Secure Act. But these are big changes that we all need to be aware of. Yeah,
they just do it one piece at a time. And this article really explains why we do weekend reading, because you've got one article that we reviewed that lays out the bill as if it's just a really good thing for retirees. You've got another one that lays it out as if it's this massive tax grab that the government's coming to you and saying, hey, we need your money. And then you have this other article that breaks it down in an unbiased format that lays out the most important elements of the bill, and you make the decision. That's the one we're obviously sharing with you that came to us from Forbes. And there's really three main pieces of this act. That is, one, get people to save more for retirement. Number two, improve retirement plans. And number three, lower costs for employers.
Yeah, first off the top there, if we look at this bill, it's get people to save more. So they're going to expand what they call automatic enrollment. They're also going to beef up some savers credits, some tax credits that incentivize you to save more. They're also going to raise catch-up contribution limits, those limits when you reach age 50, you can start to contribute more to those retirement plans. But they're also going to offer extra assistance to student loan borrowers. I think that's unique as well.
Yeah, the two that I really want to bring to your attention is, number one, I think the one that's going to frustrate maybe the mass majority of individuals is going to be the automatic enrollment provisions. Yeah. You know, it used to be, really since the late 90s, employers, they've had the option to add eligible new employees to the retirement plans at typically 3% of pay. So they could say you're automatically enrolled. That's an automatic enrollment into a retirement plan, like a 401k or a 403b. Now, with the Secure Act 2.0, should it pass, that would require employers that offer employer retirement plans, 401ks, 403bs, simple IRAs, to automatically enroll you in that plan at the 3% deduction level and then increase it every single year at 1% until it reaches 10% of your pay. I think you're going to have some irritated individuals when that comes to pay.
Well, we've worked with employers in the past about this very topic, and some seem willing to present it to their employees to say, hey, if you're not going to save, we're going to at least make it automatic, and then you're going to have to opt out. I just don't like the concept, the idea that it implores that, hey, we're going to take your money and do something with it.
Yeah, we're going to force you to do something with your finances.
That you may not want to do.
I feel like is where we've been seeing a lot of legislation headed. The other piece I want to point out was the increase in the rate in the catch-up contribution limits. So currently, those over 50, if you're over 50 years old, you can make an additional contribution to your IRA at $1,000. That's been the same since 2006, but it isn't indexed for inflation. Now it would be indexed for inflation and would also allow those of you that are over the age of 60 to add an additional $10,000 indexed to inflation to your 401ks, 403bs that used to be $6,500. Here's the catch, though. Those additional catch-up contributions that you're making to your traditional IRA, your tax-deferred 401ks, the provisions here would require those contributions to be Roth. And if they're required to be Roth in the peak of your earning years, that would make up a significant tax grab for the IRS.
Well, the one article called it the Rothification.
Yeah, and that is a true thing, and that is a real concern, I think, of individuals today, that one of the ways that the IRS can make up for their budget deficit is they can slowly eliminate the tax-deferred IRA, or they can do it with one fell swoop and say, you can no longer make tax-deductible contributions to an IRA. It's only Roth contributions. Now we're going to collect a lot more tax dollars today.
One other thing that they really wanted to focus on in this bill was improving retirement plans. Number one, delay required minimum distributions. Everybody seems to love that. The crowd cheers when you delay RMDs. Next, they're going to nix RMDs entirely for those with less in savings. That's an interesting one. But also make it easier to buy annuities in retirement accounts.
Yeah. So you've got the delay in required minimum distributions. The Secure Act pushed it back from 70.5 to age 72.
Right.
Now they would be pushing it back to age 75 over a 10-year period. So over the coming 10-year period, that's going to be a huge opportunity for you.
Yeah.
Now, if you can push back that RMD age, it gives you the opportunity to have more years where you could make sense out of doing Roth conversions, should that be what you want to do.
Right.
In addition to that, simple IRAs and SEP IRAs, it used to be you couldn't make those on a Roth basis.
Yeah.
Now you'd be able to make those on a Roth basis. And that RMD penalty that was 50% of the amount that you don't take out, that you were required to take out, now that number would be knocked down to 25%. So a very favorable change.
Yeah, and I like the fact that if you have less than $100,000 in retirement savings, they're going to say, hey, you're not required to take required minimum distributions at all. So that's kind of a neat provision. Next up, Casey, they talked about lowering costs for employers. That's always been one of the challenges for retirement plans, is making the cost more affordable so they can offer it to their employees.
Yeah, and that has been one of the biggest obstacles that I've had in working with employers to set up a new 401k plan. Is It's not cheap. That can be very expensive just to get a 401k in place. It can cost thousands of dollars. And now they would be offering a tax credit up to 100% of that cost. And that would be something that would allow more employers. They're projecting hundreds of thousands of employers would start offering more 401ks to their employees. And so there are some positive things that you're going to find in this new legislation, but you need to keep an eye on what ultimately happens on the back end. I think most legislation, when it first gets through the House and Ways and Means Committee, it tends to look fairly attractive. By the time it actually is passed, it can be a completely different beast. And there's going to be a lot more that comes out of this in the coming months, where we're going to be doing some planning with our clients specifically around these changes in those coming months. And if you want to stay up to date on what those changes are, we'll continue to keep you up to date, not just here on the radio show, but also through our weekend reading for retirees. So sign up at retirewithpurpose.com if you'd like to sit down and really get a picture of how these changes would impact you and your retirement plans. We have a special offer today for the next 10 callers. We'll conduct a complimentary financial review with you. You'll do that with an independent financial advisor on our team, either in person or through a video meeting from the comfort of your home, where we will help you determine how prepared you are to not handle just future legislation, but also things like inflation, things like rising taxes, healthcare emergencies. Is the stock market going to go up or down, way up? In short, we're here to take the guesswork out of financial planning for you, and that can take just 30 minutes. So give us a call right now for the next 10 callers that call or text consult. Text consult to 866-482-9559. Give us a call or text consult right now to 866-482-9559, and we're offering a comprehensive financial review with no obligation for the next 10 callers. Stick around because we have some amazing offers coming up for you here later in the show. We've got all kinds of cool books that we're going to be giving away. But first up, we're going to be answering questions from you on life insurance and retirement, paying off your mortgage in retirement, the rule of 100 when it comes to taking risk with your retirement savings, that and more. So stick around.
You're listening to Retire with Purpose, hosted by Casey Weade and Marshall Johnson. This is Retire with Purpose, hosted by Casey Weade and Marshall Johnson.
Welcome back to Retire with Purpose, the science of retiring with confidence, the art of living with purpose. This is your host, Casey Weade. Joining me, my good friend and co-host, Marshall Johnson, here with me. And it's our opportunity to turn the mic back to you, see what's going on in your world. What's keeping you up at night? What kind of concerns do you have, financial concerns or non-financial concerns about retirement? If you have questions about things you've heard, maybe strategies you're considering, drop us a line. You can email us those questions at info@howardbailey.com. That's info@howardbailey.com. Or just go to retirewithpurpose.com. In the bottom right-hand corner of the screen, there's a little text box there. Click on that and then type your question right there. Send it over to us, and then we will get you back an answer. If you'd like to feature your question on the show, we'll welcome you to do that. If you would like your privacy to be protected, then we won't share it here on the show. It's completely up to you. Again, check it out at retirewithpurpose.com. And let us answer those questions and eliminate those concerns that you might have, financial or otherwise. Our first question today comes from Diana. And Diana says, how should I be utilizing life insurance as part of my retirement plan?
Diana, wonderful question. Life insurance is a unique tool that certainly can be a part of somebody's retirement plan. Oftentimes we see life insurance used as a way to transition assets the most tax favorably way to the next generation, right? Like a tax-free death benefit. That's a good way to transfer wealth. Other times it's being used by families to offset any sort of tax burden. And other times Casey can allude more details to this, but oftentimes it can be utilized for much more complicated and much more involved strategies. But I think, a lot of people, life insurance is not necessarily a tool for their retirement box, but those in the know can really dig in and learn some unique strategies.
Yeah, life insurance is the most flexible tool that is out there in the financial world, and it can have any number of different uses. As Marshall mentioned, the most common use of life insurance is legacy purposes or protecting your family in the case of death. It's an estate planning tool, right? If you pass away, it protects your income for maybe any survivors that you could have, maybe a spouse in retirement, maybe your children while you're still in your accumulation or your working years. Maybe you're in an estate tax situation and you need to cover estate taxes so the kids can retain the farm. But there's a lot of other uses as well. I worked with a gentleman earlier this week, and we were using this tool for a cash alternative to the bank, long-term care purposes, legacy purposes, and utilizing it for income purposes in retirement. We had a lot of different uses and a lot of different types of policies structured different ways to cover different needs. One of those being a cash alternative. He has overfunded this account, and that means he can have his money back at any time. There aren't any penalties, and it's indexed to the market. So that particular indexing in that account, we're able to capture a percentage of the gains in the index that we're looking at, the S&P 500 for instance. Index is up 50%. Maybe we're limited to gains of 25%, maybe we're limited to gains of 10%. It depends on the policy, but where else are you going to find a totally liquid tax-deferred vehicle that you can set aside funds and make a much higher return than you can find in the bank and pass those funds on tax-free? This is someone that likes to carry additional cash on the sidelines for future uses for a lot of opportunities that they may have coming their way. Mm-hmm. In addition to that, the death benefit attached to that account can be used for long-term care while he's living, while his wife is living. So if they never use the cash, but they have a long-term care need, they can accelerate the death benefit, use it for long-term care. And then we have some other policies that are structured for tax-free income in retirement. These accounts fall under the same tax code as the Roth IRA or the Roth 401k, so they're able to take funds out of that account on a tax-free basis throughout the retirement years. And that's not for everyone. But for this individual, they're already maxing out their 401k. They're maxing out all of those tax-advantaged retirement accounts. So we're using life insurance as a supplemental tax-advantaged vehicle for supplemental retirement income that's more tax-advantaged than a tax-deferred IRA or a brokerage account for that matter.
Yeah, I like what you said there, that it's certainly not for everyone. It's not step one in the process of building a retirement plan. But I got to tell you, sometimes I get frustrated. Casey, yesterday I was in carpool line picking up Grady from school, and I'm scrolling through social media, and I see a very popular financial podcast guy, and he makes a post that says, if your financial advisor is talking to you about utilizing life insurance as an investment, you have a insurance salesman, not a financial advisor. And I think there's still a lot of closed-minded thinking around strategies like this.
Well, there's a lot of that out there. That historically has been true. It's the same thing with annuities. My dad would always say, the reason annuities got a bad rap, and the good majority of his life savings is in life insurance and annuities. He'd say the reason annuities or life insurance gets a bad rap is because originally, 10, 20, 30 years ago, it was individuals that are out there working for an insurance company, and the insurance vehicle was a one-size-fits-all solution. It was good for your income. It was good for your long-term growth. And I've seen this with friends of mine. I had a friend of mine that was sold a whole life insurance policy.
Sure.
He didn't need the death benefit. He wasn't married, didn't have children, and he wasn't saving anything into a Roth IRA or his 401k at the time. Right. He didn't get his basics covered, and now he's contributing dollars to a low-yielding vehicle that he really doesn't have a need for in the first place, but someone needed to cover their bills. And so they sold that policy to him, and now we've got to figure out how to unwind it over time because it's not the best vehicle for him. I think you're seeing more financial planners, certified financial planners that are utilizing insurance as a tool because they recognize it is just that. It is a tool. And with this huge wave of individuals stepping into retirement, wanting some type of protection, they have risks that they want to address. There isn't another risk management tool that can be solved through stocks and bonds. Stocks and bonds are not going to provide you a guaranteed income you can't outlive. They're not going to provide you unlimited long-term care benefits. They're not going to provide a tax-free death benefit to your heirs. There's a lot of things that the original stock bond approach just can't solve for your average retiree.
And you talk about tax diversification too. You know, we talked in the first segment about Secure Act and the tax law changes. You and I personally talk a lot about diversifying our tax buckets, and that's one area where you can begin to diversify your future taxation. Diana, wonderful question. We could probably turn it into a whole segment. Next up, we got Mike. Mike says, Casey, what are your thoughts on utilizing the rule of 100 as an investment guideline? Is this an acceptable way to allocate my money?
Let's be careful with the word guideline. I would rather it be said as rule of thumb. It is a rule of thumb. The rule of 100 is a rule of thumb. It is not a guideline. It's something that may offer you some direction on the way to retirement. You're 20 years old. Should you? Let's talk about that. You're 20 years old. Should you have any money in bonds? Especially in a low interest rate environment. No. You're only going to have 80% in equities when you're 20 years old. And you're not going to touch the money for the next 40, 50 years? No, that's ludicrous, right? I'm 35. Am I going to have anything in bonds? Absolutely not. My Roth IRA, my 401k, it's 100% equities because I'm not going to touch that money for decades into the future. That is a horrible rule of thumb. Now you get to the age of 70, and it's been argued that it is a good rule of thumb. However, I've met individuals that are 70 years old that don't need any of the retirement savings because they have guaranteed retirement income from their pension. They have guaranteed income from maybe an annuity. They've got guaranteed income from their Social Security. They don't need their retirement savings outside of inflation. Is it going to be best to allocate dollars that are going to be indexed to inflation to bonds? Probably not. Equities have been one of the best vehicles for outpacing inflation, so they should probably be more like 70% equities instead of being 70% fixed income. This is a rule of thumb that I think in a large part has been used by salespeople to pressure you into more conservative vehicles, or financial planners trying to make themselves look smart by saying, hey, there's this rule of 100. You ever hear of it before? Yeah. Why don't we go ahead and set aside, you're not following the rule. We need to fix this, when it really isn't personalized, and personal financial planning needs to be personalized.
Yeah, great analogy. Coming up here in a bit, we're going to talk about Steve Parrish, and he's got an article on rules of thumb, and he uses the analogy. It's like you're in New York and you want to get to California. One of those general rules of thumb would be head west, young man. Yeah, you're going to head west, but after that, you need to get very specific on your precise course of action. I think that's a little bit like this rule of thumb. Take it with a little bit of a grain of salt. If somebody's 90 years old,
I've got 90-year-olds that are 100% equities because they don't need the money. It's really their kids' longevity. It's their kids' time frame.
It's going to be for the kids. Yeah. So wonderful question.
Our last question comes from Catherine saying, do you think it's wise to have a mortgage paid off prior to retiring? I know being debt-free is great, but I don't want to be hit with a large amount of taxes upon paying the house off all at once either.
Well, Catherine, I'm not entirely sure what you mean by the large amount of taxes upon paying off the house. Maybe you're referring to pulling money out of IRAs that would result in a big tax hit. But no, I think the days of paying off the mortgage before retirement are changing. It's not the common thing anymore if you look at the statistics, primarily because interest rates are at all-time lows. You've got secure debt, very secure debt with extremely low interest rates. It is not a necessity, in my opinion, at this time.
Yeah, and if you're talking about paying a large amount of taxes because you pay off the house, it's probably either because you're taking a distribution from an IRA to pay off that mortgage, which I would, in 99% of the situations, I'm going to advise against that. Then It could also be you're concerned about mortgage interest and losing that mortgage interest deduction in the peak of your earning years. Yeah, however, if you're that close to paying off the home, there's probably very little interest being paid year over year anyways. So really examine how much that interest deduction really is going to impact you once the mortgage is paid off. If you have questions like this, make sure you submit them to us. You have questions about taxes, you have questions about estate planning or income planning, Social Security, go on over to retirewithpurpose.com. There's a little text box in the bottom. Drop us your question right there. We'll get you an answer. If you would like a personalized assessment that will allow us to answer that question in a more personalized way, we have a special offer for you today. For the next 10 callers, we're offering a complimentary financial review with an independent financial advisor on our team, either in person or through a video meeting from the comfort of your home. We're here to help you get prepared to handle all the things retirement will throw at you: inflation, healthcare emergencies, stock market crashes, rising taxes. In short, we'll take the guesswork out of financial planning for you, and it can take just 30 minutes. So right now, for the next 10 callers, you can do one of two things. You can call us, or you can text us at this number. You can text CONSULT, that's CONSULT, to 866-482-9559, 866-482-9559, or you can give us a call right now at 866-482-9559 for a comprehensive financial review at no obligation for the next 10 callers. Stick around because we have some awesome gives for you. If you're interested in learning more about healthcare and retirement, market volatility, taxes, inflation, we have some resources for you, so stick around.
You're listening to Retire with Purpose, hosted by Casey Weade and Marshall Johnson. This is Retire with Purpose, hosted by Casey Weade and Marshall Johnson.
Welcome back to Retire with Purpose, the science of retiring with confidence, the art of living with purpose. This is your host, Casey Weade. Joining me, my good friend and co-host, Marshall Johnson, and some other very special guests. We've got some cool offers, so stick around. We're going to be highlighting top retirement pitfalls and their effects on your overall retirement strategy, including things like healthcare costs, taxes, market risk, and inflation. One or even several of these components could be a top financial concern for you, which is why addressing them with your financial advisor and creating a customized strategy to protect your lifelong savings is just so important, and why we have so many awesome conversations with awesome guests on the podcast about this. We had the opportunity to feature several amazing experts on the Retire with Purpose podcast who provided insight on each of these costly retirement risks and mistakes. So today we're going to be looking back at some of our most popular episodes and focusing on how to keep more of your hard-earned dollars in your pocket where they belong. You can check out each of these featured guests at retirewithpurpose.com/podcast or wherever you listen to your podcasts. We're going to get started with our first guest here talking about healthcare costs with Medicare expert Danielle Roberts. This was featured on episode number 173 of the podcast. Danielle is the co-founder of Boomer Benefits, a health insurance agency that helps baby boomers and seniors navigate the complex world of Medicare. Danielle joined the podcast to discuss why Medicare is so complex, the major mistakes people make when choosing and using Medicare, and how to get guidance you need. She's going to be sharing with us right now why the $300,000 to $500,000 projected cost of healthcare expenses in retirement is accurate or not.
Given the life expectancies that we have today, I do think they are pretty realistic, because you're going to spend several $100s on the cost of Medicare itself, plus your supplemental coverage, plus deductibles and copays. And then Medicare doesn't cover things that we're used to having covered by our employer coverage. So dental, vision, and hearing, any routine dental, vision, and hearing needs are also not covered by Medicare. And so this is going to be an expense that you're going to pay for out of pocket, either in cash for those things or in a standalone insurance plan that's going to help pay for them. Hearing aids and eyeglasses, these things are not cheap. And we're at a time in our life when we need them more than any other. So that is also money that needs to be built into your plan. And probably the biggest thing is long-term care. So a lot of people don't realize that Medicare does not pay for long-term care. So when you reach that point in your lifetime and you need help with the activities of daily living and you move into a facility, I've got a girlfriend that just did this with her husband's father. It's thousands of dollars a month to live in a place like that. And if you're in there for a few years, that alone can be several $100,000. So I think that cost picture is pretty accurate and in some circumstances might even be on the low side.
There is a reason that healthcare is one of the biggest concerns for retirees because it's going to be one of your biggest expenses in retirement, and it will potentially be your biggest expense if you don't plan appropriately. Get more information on healthcare by giving us a call. We'll help you through your Medicare decision-making process and integrate it with your comprehensive financial plan. Give us a call at 866-482-9559. 866-482-9559, or just text consult to that number. Next up, we're going to be talking taxes with David McKnight. This was a feature from episode number 114 of the Retire with Purpose podcast. David is a nationally known tax expert and author of the world best-selling book, The Power of Zero. It actually became the #2 most sold business book in the world upon its launch. David has dedicated his career to warning us all why we should expect higher taxes in the future and how to be in the 0% tax bracket when you retire. We're going to be having a live event with David McKnight here in Fort Wayne later this year. If you want more information, give us a call, 866-482-9559. David's going to share with us right here what history tells us about the future of tax rates.
We are experiencing the tax sale of a lifetime. We don't recognize how good it is because we don't often think about how high tax rates were under, during the 40s, 50s, 60s, 70s. It wasn't until Reagan actually got into office that tax rates started to lower dramatically. But we're in an environment where politicians are talking about raising the marginal tax rate to 70%. I heard Elizabeth Warren talking about raising it to 90% on the wealthiest among us. And the thing you got to remember is when that highest marginal tax rate goes up, historically, it's a bellwether for all of the other tax rates. As that highest marginal tax rate goes up, all of the lower ones tend to rise right along with it. And that's why we keep our eye on that highest marginal tax bracket. So, we have to, I think we've sort of been lulled into this false sense of security that tax rates are low and they'll always be low. Well, history tells a different story.
If you're concerned about taxes and you want to know what to do about it, we have a special offer for you today. We partnered up with David McKnight, not to just have him as a guest live for you in Fort Wayne, but to offer his best-selling book to you right now, The Power of Zero, How to Get to the 0% Tax Bracket and Transform Your Retirement. It's free to listeners here today. This book was ranked #9 by Forbes as one of the best-selling financial resources in the country, #2 most sold business book in the world in September of 2018. In this book, you'll find a step-by-step roadmap on how to reach the 0% tax bracket by the time you retire. We have a box of books here. We're going to give them away until they're gone. Call now or text the keyword zero to 866-482-9559. That's keyword zero to 866-482-9559 and claim your complimentary copy of The Power of Zero. Next up, we're going to be featuring Dirk Cotton, who was a guest on episode number 25 of the Retire with Purpose podcast. After retiring as a senior executive at a Fortune 500 company, Dirk is now living out his second act as the founder and publisher of his blog, The Retirement Cafe, one of the most popular and most award-winning retirement blogs on the net. In his blog, he focuses on retirement research, specifically on retirement planning for the unwealthy or those with less than $100,000 in savings, and also provides retirement coaching along the way. He joined us to discuss the dangers in trying to predict the future and many factors that people often don't even understand or think about as they prepare for retirement. We're going to share a clip with you right now where he discusses the risk of basing your investment decisions, especially when it comes to the market, on averages.
First of all, the average is not nearly as important as the sequence of returns. And there have been periods during that 7% average return when you would have gone broke fairly quickly because of sequence returns, not because the averages themselves. You look at the average, and more often than not, if you're looking at an average, there's a 50% chance that you're going to fail. So what you really need to look at is the worst case and make sure you avoid that, or at least that's what I think. So there There are two kind of schools of retirement planning that you read about. One is the probabilist school, and the other is the life cycle school of planning, and the differences in probabilities. So a probabilist would say, hey, you know what? 7% almost always works. And a life cycle guy, an economist in particular, because probabilists tend to be equity fans. But if you talk to economists, they'll say, yeah, but do you really want a 1 chance in 20 of going broke in your old age? So that's the major decision you have to make with your retirement plan. Are you one of these people that has so much faith in probabilities in the stock market that you're willing to bet your future on it? Or do you want to say, hey, you know what? There's a 1 in 20 chance that things could turn out really bad for me. So the first thing I want to do is build my plan around making sure that doesn't happen.
Yeah, that is actually the safety first school of thought, as past podcast guest and professor of retirement income, Dr. Wade Faust, shared with us and wrote a book about safety first retirement planning. That's the type of planning that we do. We don't want that 1 in 20 chance. We don't want to leave your retirement future, your retirement success up to chance. If you want to get more certainty around that, give us a call, 866-482-9559. Next up, we're going to be featuring David Littell. This was episode number 123 of the Retire with Purpose podcast. David is the chair in research at the American College of Financial Services. He teaches and develops courses and textbooks meant to teach individuals about retirement. He's a co-creator of a designation I hold, the Retirement Income Certified Professional designation, and coordinates its course curriculum. His work has helped countless financial advisors, myself, better plan for retirement needs and understand how to work with their clients. David joined us on the podcast to discuss his own transition into retirement and why he decided to do it at the age of 66 and what his strategy looked like to get him there. That was the most interesting thing about this interview. This is David's answer to what strategy of investments can be used to produce adequate retirement income and meet inflation needs.
Well, to me, that you don't have a single investment that addresses all those issues. You build a plan that addresses those issues. So one, you want to make sure you have adequate resources for your entire life. So you might be building an income floor with annuities or by deferring Social Security to get more guaranteed income. And then with your investments, you're usually, if you do that with some of your money, with the rest of your money in your investment portfolio, well, now you're to deal with inflation, we're usually taking more risk. We're investing in something that's more aggressive in order to get inflation protection. I feel like that's one of those questions where you think, we're all looking for an easy answer, and I'm sorry, there isn't any easy answers. It requires a patchwork, building a plan that has a number of different pieces to it. In order to, you can address all that, but not in. I wouldn't say the answer is an investment or a particular investment.
I believe this is the problem with the majority of plans that we audit. Everything's in one thing, right? If everything you have is in the market, if everything that you have is in stocks and bonds, if everything's in ETFs or mutual funds, if everything's in your 401k, it's not diversified. You can't expect that one portfolio that's in the market to solve all of your needs, from meeting your emergency needs, income to last the rest of your life, keeping up with inflation, leaving assets behind to your heirs, taking care of your long-term care needs. You need a truly diversified plan. If you don't feel like you're getting that, then that's why we have a complimentary financial review offered right now for the next 10 callers, where you'll meet with an independent financial advisor on our team, either in person, through a video meeting from the comfort of your home. We'll help you determine how to handle all these pitfalls, from inflation to healthcare emergencies, rising taxes. In short, we'll take the guesswork out of financial planning for you, and it can take just 30 minutes. So for the next 10 callers that call or text the word consult to 866-482-9559, 866-482-9559, right now we're offering a comprehensive financial review at no obligation for the next 10 callers that text or call consult at 866-482-9559. Stick around, because next up, we're going to be talking about an article that Steve Parrish recently released on retirement rules of thumb.
First-time callers are eligible to receive one in-stock book per request. Limit one book per week per household, up to 3 books per calendar year. See full terms at howardbailey.com/terms. You're listening to Retire with Purpose, hosted by Casey Weade and Marshall Johnson. This is Retire with Purpose, hosted by Casey Weade and Marshall Johnson.
Welcome back to Retire with Purpose, the science of retiring with confidence, the art of living with purpose. It's your host, Casey Weade. Joining me, my good friend and co-host, Marshall Johnson, to discuss another article from our Weekend Reading for Retirees email series. What is that? Well, you'd know if you signed up. You'd get one email every single Friday from myself that outlines 4 articles that are trending topics in the retirement planning space, all designed to help you make better decisions in retirement about taxes, about inflation, about estate planning, and new legislation that might be coming out that'll impact your planning. You can sign up at retirewithpurpose.com, where you'll receive that email with the articles, a breakdown and summary that's easy to digest, and also my number one takeaway from the article. We're going to outline or highlight one of those articles right here on the show with you that was written by one of our past podcast guests. It was actually written by Steve Parrish, and Steve Parrish wrote an article for Forbes. It is titled "A Second Look: 4 Retirement Rules of Thumb."
Steve Parrish. We love Steve Parrish. He always writes wonderful articles. You know, the guy's been doing it for 40 years. He's got a great perspective on things, and I think he's got a great take here on rules of thumb, Casey, and how...
Yeah, a lot of his articles are debunking myths or just saying, oh my gosh, let's look at the facts here, people.
Right,
That's what I see a lot of what comes out of Steve Parrish. He's an academic, and he hates salespeople. He hates the ads. He hates what he sees out there that is the spreading of myths and confusion, and he tries to debunk those things and make retirement simpler and easier to understand and plan for.
Well, and I think, you know, this is an area where we hear a lot of these things. You know, everybody's heard buy low, sell high, you know, diversify your risk. It's like everybody's ingrained in that, but he kind of takes it a step further. And I think it's neat how we dig through these, because they can be problematic if you just rely on these rules of thumb, which he says are often opinions.
Yeah, you know, he walks us through the 80-20 rule, the age 65 is when you should retire, the 4% withdrawal rule, the
everybody's heard
rule of 100, you know, a lot of rules that maybe you've heard from a financial planner or talking head at some point or another. And as you said, Marshall, he says, you know, they can be useful to kind of point the way, maybe on your way to retirement, you're 30 years out, you don't really know what to do, how to get started. Maybe these are somewhat helpful, but beyond that, they really lose their value, especially when you're getting close to your retirement date. And there's a great analogy that's used here, and we want to share that with you. Think about heading from your hometown to California.
Sure.
You want to head to California. Well, a valid rule of thumb is to, hey, head west. You'll get there, I think. I mean, I don't know. I'd probably end up in Washington or something. You know, definitely. I mean, it could be Canada, could be Mexico, you know, but at least I would be heading in the right general direction. I would eventually find my way. You know, but what you should do is, once you have the direction in mind, we're headed west, you'll need to get more specific as you get closer. You need to have a roadmap. You need to have an atlas. You need to have a GPS. I used to use MapQuest, you know, printouts, right?
Yeah.
To get to that desired destination. I was having this conversation with my wife just the other day. I said, man, isn't it amazing? Like, I don't know if I could get anywhere anymore without directions. And she said, yeah. How did we get anywhere?
Right.
And, well, I used to run home appointments all over the Midwest. And I said, well, I would print out my MapQuest directions and I'd have them right there. If you make one wrong turn from those MapQuest directions, oh boy, you're in trouble, right? You could be hours out of the way, and then you have to stop and ask for directions or grab an atlas, grab a map. You know, we don't need to do that. You know, and I think technology has allowed us to get more precise when it comes to getting to our desired destination. information. The same thing's true with financial planning.
Sure.
We need to leverage technology in order to get away from these rules of thumb that'll get you somewhere close to where you want to go, and leverage technology in order to get you right where you want to be, in order to architect the dream financial home, if you will.
Yeah, the first one right out of the gate is kind of I shouldn't say a newer one, but I guess I've been hearing about it more from families that come in to see me. And they say, well, I always hear that you need 80% of your pre-retirement income in order to live comfortably in retirement. And so Steve kind of digs into this and says, well, yeah, obviously you're not going to have some of the expenses of commuting to work. And also you're not going to be paying into Social Security. You probably don't have a mortgage if you're close to retirement. So maybe you're not going to need as much in expenses. But he goes on to share that a lot of people are going to need more than 80% of their living expenses in retirement.
Yeah, some will need more, some will need less. I've got a client I met with this week is making $1 million a year. You think he needs a $800,000 income in retirement?
Sure.
No. He needs about 20% of that. He needs about $200,000 a year in retirement. Everybody is going to be different. Studies find today that the number of individuals that are transitioning into retirement with a mortgage, it's nearly doubled over the last 30 years. Mm-hmm. You need to take that into consideration. Maybe you should be in retirement with a mortgage for that matter. What about dynamic spending patterns?
Yes.
Some of the latest research that some of our past podcast guests have shared with us, share with us the true spending patterns of retirees, how much that's changed over the last couple of decades. And there's great research around that. Dr. Dave Blanchett, who is the head of retirement research at Morningstar, he shared with us during his interview with us that he thinks of it as a retiree spending smile, right? During those first few years of retirement, the go-go years, you're going places, you're doing things, you might spend more in those first 5 to 10 years of retirement than you did while you were working. And then your expenses start to drift downward. And then towards the end of life, your healthcare expenses peak back up when you're in your 80s or 90s, and then they start to smile back up at the other side of your mouth. And once we actually factor those things in, with inflation, we don't see a major impact of inflation on average for the average retiree over the last 30 years.
Yeah, I was sitting down with a family just the other day, and they were saying, you know what, we really just want to know, do we have enough? Can we retire? And we started to look at the numbers, and he also threw out that 80% number. Well, he was not taking into account all of his 401k savings as well. He's saying, well, if I make $100,000 a year, I need this much money. It's like, well, you're saving $24,000 a year right now into your 401k, plus your Social Security taxes, plus the higher income taxes. He was generally way off on that assumption, but it's good to at least understand where the flaws are with this and use it as, again, pointing you in the right direction.
Steve Parrish says the real rule here is to examine your current expenses and ask yourself which costs will remain in retirement, which will cease, and also ask yourself what the trajectory of your planned expenses will be. Rule number 2. Your retirement should begin at the age of 65.
Well, that's going to change a lot. I mean, we're seeing more and more families that are working till 70. I've got one guy that's going to work till 75. Longevity is extending that age.
Yeah, just because you get Medicare at 65 doesn't mean that you should accelerate your retirement date. Mm-hmm. Maybe you shouldn't. Retirement has become more of a process than just this event, right? It takes time to nail this down. And his guidance here, Steve Parrish's guidance, says what you really should be doing, rather than just saying I'm going to retire at 65, is assess in advance what your possible retirement income prospects will be at various ages, and then work backwards to determine what age you can afford to retire. As I did this with a client earlier this week, we were looking at different retirement ages in the amount of income we would be able to generate for a lifetime if they retired at 65 versus 68 versus 70 or 75. We were stress testing that income and letting that couple make that decision around how much income is going to be adequate, how much income they really want, and really understanding the trade-offs of those two things. If you want to sit down and get an assessment where we can show you how much retirement income you can generate at different ages, give us a call or text consult right now to 866-482-9999. 9559. The next rule of thumb, the 4% rule.
The dreaded 4%. I think this is the one that most people know by heart, and you take your balance, and the calculation gets kind of messed up too on this. But the 4% withdrawal rule, we can largely throw that out the window. It may be a good starting point to have an assumption, but it's certainly not ideal.
Yeah, he says, first of all, the math behind this rule, it's based on past market performance. Doesn't tell us anything about what the future holds. Number two, it's not intended to calculate the ideal amount to withdraw. It's meant to determine the minimum safe withdrawal.
Yes.
And if you adhere to this too strictly, you could take too little retirement income. You could take too much for that matter. It really depends on the investment strategy and your income needs and how long that you're going to live. First of all, the performance using the 4% rule wasn't tested over the last 20 years. It hasn't been tested. The original assessment was not testing the tech bubble time period, the Great Recession time period, and we have low bond yields today, record low interest rates. And finally, how long are you going to live? 30 years in retirement may no longer be a reasonable assumption. So what should you do? Steve Parrish says, number one, have a backup plan in case the markets perform poorly. Number two, recognize that the 4% rule says that you're going to maintain a balanced portfolio of stocks and bonds, equities and fixed income. So you have to continue to maintain that allocation throughout retirement. Are you taking enough risk? And number three, consider adding some guardrails, some techniques that'll help you weather some of those storms that'll inevitably come your way in retirement. Rule number 4, the rule of 100.
Yeah, I love this. He says the rule, take your 100 minus your age. That's what you should have in stocks. Rule is right up there with the don't go swimming for an hour after you eat.
Yeah, that's great. And he says, really, there's no foundation for this rule. There's no foundation for the rule of 100. The amount of your risk in your portfolio depends on a lot of other factors other than simply your age. And what you need to do is do your homework, get signed up for weekend reading for retirees at retirewithpurpose.com. Get some help and keep your plan up to date. And we have a special offer to help you get that done today. We're offering a complimentary financial review for the next 10 callers where you'll meet with an independent advisor on our team, either in person or you can do this through a video meeting from the comfort of your couch, and we'll help you determine how prepared you are to handle retirement pitfalls like inflation, healthcare emergencies, stock market crashes, rising taxes. In short, we'll take the guesswork out of financial planning for you. It can take just 30 minutes. So for the next 10 callers that call or text the word consult to 866-482-9559, 866-482-9559, right now, text consult or call that number. We're offering a comprehensive financial review at no obligation for the next 10 callers. Text or call consult at 866-482-9559. We'll be right back here next week, same time, same place on Retire with Purpose.
You've been listening to Retire with Purpose, hosted by Casey Weade and Marshall Johnson. Investment advisory services offered through Howard Bailey Securities, LLC, a registered investment advisor. Working with Howard Bailey Securities, LLC cannot guarantee investment success or that specific financial goals will be achieved. Certified Financial Planner Board of Standards, Inc. owns the certification marked CFP and Certified Financial Planner in the U.S., which it awards to individuals who successfully complete CFP Board's initial and ongoing certification requirements. Howard Bailey Financial is a registered trademark of Howard Bailey Financial. All rights reserved. Information is not intended to provide specific legal or tax advice. Howard Bailey Financial nor its advisors are qualified to give tax or legal advice. You are encouraged to consult with your tax or legal professional for guidance on your individual situation. This radio show is a paid placement.